You're watching us here on Chartbusters on CNBC-TV18, and as we speak, we have the markets falling, but one of the stocks on our radar is Godrej Consumer. Reported a weak set in the third quarter, but as the company had guided us earlier itself, that it would be a weak quarter on account of the rise that we've seen in palm oil prices, and at the same time, we've seen some weakness in demand sentiment as well. Aasif Malbari, who's the Global CFO and President of the Middle East, Africa and International Markets Business, joins us now. Aasif, you earlier called out the weakness in the third quarter. The results reflect that as well. The question is, what next? From the peak, palm oil prices have come off. The street is expecting demand to come back as well. We've seen some recovery in FMCG stocks from the lows as well. Do you believe that, the worst is behind? What are you seeing in this quarter so far?
Sure. No, so thanks, Mangalam. I think as we had called out, this was a quarter where we had seen a lot of temporary headwinds against us. And we saw these in two of our core categories. Personal wash is going through a fair bit of commodity inflation, as a result of which a lot of pricing has gone into the market. As we indicated in this quarter, while we kind of saw mid-single digit declines, we actually kind of broadly offsetted most of that with price increases, with giving a flat revenue kind of growth in the category. And then we had some bit of, again, temporary headwinds in terms of HI, where seasonality did kind of not support us in the best of the fashions. So we do kind of see these kind of reverse off as we kind of move on in next quarter. Definitely, there will be sequential improvement. Having said that, we've delivered last 6 quarters. We have been delivering broadly in our India business a UVG of 6 to 7% weighted average. And this was a kind of, I would say, a quarter which we wouldn't want to kind of remember in terms of a growth delivery. There is always an effort to kind of get back to that level of delivery. We should see a sequential improvement. And I think as we get into FY26 in first half, we should kind of start getting back onto those kind of trend lines.
All right, sequential improvement in the fourth quarter and get back to 6 to 7% underlying volume growth in the India business as well. But what about the India business margins? How long before you claw back to your earlier guided range of 25 to 27% point? Because you had been talking about that for the last many quarters. The last couple of quarters have been an aberration. If you could give us a newer range that the street should be working with as well, and how long before you get back to this 25, 27%?
So I think let me kind of break this margin piece in 2 parts. If you kind of see historical consolidated margins for GCPL, they've actually been between 18 to 22%. We closed margins last quarter at a consolidated level at 20% plus. So from a consolidated margins perspective, it's still a good journey. We've been able to kind of hold a good shape of 20% levels of EBITDA for consolidated GCPL as a whole. It's coming in on the back of a significant margin improvement, which we've done over the last 2.5 years onto our international geographies. International geographies margins, almost 2 years back used to be at 10%. YTD 9 months is kind of gone to 16% level. So we've got like a big kick from our international geography margins. India margins, which are range bound between 24 to 27, have breached on the downwards. Definitely, we know that we can bring these and we will operate it within the band. Likely to take a quarter or 2 to kind of get back into that band, because in Q4 we will see some bit of a margin pressure yet, because still there is I would say, a spillover effect of palm oil, and while we've taken pricing, it will still take kind of time to kind of catch up to get those margins in that normative range. So we could see a few months to kind of get there, but we feel very comfortable operating within that banded margin, and it's temporary pressures which have kind of taken us off. So that's the way I would kind of respond to that.
Okay, all right, Aasif, hi and welcome to the show. Could you tell us what about household insecticides business, which in the start of the previous quarter, that I think was impacted by delayed winter. Has that seen some kind of pickup in quarter 4?
So again, Mangalam, I think we're very happy with what I would say is our interventions in the household insecticides category, and how consumers have reacted to it. So I think we launched household insecticides, the incense sticks. That's done extremely well over the last couple of quarters, and it's kind of gained high single-digit market share in a very short span of time. and we are seeing a great runway to growth there. Our new product, which got introduced with a new molecule, is also seeing early green shoots of gaining share in the electric segment. So if you look at it from a segment performance perspective, we're kind of doing well in pretty much all the segments and showing early signs of gaining share in all of that. There has been a bit of a seasonality / I would say urban consumption stress for the larger industry as a whole. And we're hoping that that will kind of fall in place as we go along.
All right, so the industry is facing headwinds, but you believe that you're doing better out there. What about the Rayman portfolio? I mean, we did see a big growth in the KS business, that portfolio, but perfumes or deodorants, that's still struggling. What's the likely growth rate here that you're seeing?
That's right. So definitely KS has delivered a strong double-digit volume growth and is doing extremely well. Very strong green shoots in terms of our ability to kind of bring in the new products and to kind of premiumize the portfolio. So quite happy with the sexual wellness part of the business. In terms of deodorants, we did take some time to kind of get a balanced GTM strategy. As we speak, we are seeing market share gains in urban, we are seeing market share gains in e-com. On the GT part of the business, especially in urban GT, we did make a few changes. The changes are falling in place as we speak, so we're quite confident that that part will also start seeing double-digit growth. So I think structurally, we're happy with the portfolio. Some bit of the corrections in terms of the sales system is something which we've made. So happy with the acquisition in totality.
All right. And earlier in the conversation, Aasif, you did speak about the improvement that you've seen in your international business itself from around 10% to 16%. So the question is there more room for growth out there? I presume anywhere between 18 to 20% would be the international business band. Would that be a correct assessment?
You are right. I think there is a scope to kind of take up margins in the international business up by another 200 bps for sure. We will need to kind of consolidate. Given that we've had a good runway, we need to just consolidate margins at these levels and then build from here. But we do have plans to kind of take it up further. We're also seeing early green shoots in some of our international geographies in terms of the macroeconomic conditions. So like countries like Nigeria, countries like Argentina are kind of showing much more stability in terms of currency. We're seeing much more stability in terms of macro conditions compared to what it was a year and a half back. And that's also kind of supporting the journey to kind of hence lead improved conditions. But yes, there should be an improvement from here on.
All right, Aasif, let's get some simple details out of you. What would GCPL look like at the end of FY26? You could give us a few details on revenues, margins, net profit outlook as well with the visibility that you have.
Yes, it is. I think it's interesting times. So I think would kind of wait possibly, Mangalam, for a quarter to kind of start giving guidance for FY26. We typically kind of do it after we close the year at the time of our annual conference. So let's wait for a week on that. But definitely we would want to kind of get back to our running rates of high single-digit UVG for the India business. Get margins moving towards normative levels, both in India and improving it for the international business. Pet care business, what we'd announced, the actions are progressing very well, both in terms of the product and in terms of the plant. So you should hear from us very soon in terms of our launch plans.
All right, we'll hear soon from your launch plans. Aasif, thank you so much for joining in. Target moving towards single high-digit volume growth for the next year, along with margins towards that normative levels, though will take a couple of quarters for it to settle out here as well. The stock opened lower as the street saw those numbers, but thereafter there was buying at lower levels because a lot of that was perhaps priced in as well. Though the market